Hello there. Thanks for joining us on Business Incorporated. I am Bisi Adebayo. On the show today, Nigeria's largest financial services group, FBN Holdings, reports a 13.7% increase in total assets for the year ended 2016. Plus, Zimbabwe meets conditions to clear arrears to World Bank AFDB, paving the way for possible future funding from the International Monetary Fund. And South Africa announces an increase in the retail price of petrol and the wholesale price of diesel from May. Well, we begin with the markets in Africa, where the numbers are mixed. And here in Nigeria, the all-share index was down 0.03% at intraday as investors continue to digest company earnings filtering into the market. In South Africa, the JSE index was 0.5% positive, though at 53,949.52. The market is closed in Egypt for the weekend, but on Thursday, the index retreated 1.15% on profit-taking. Kenya was also seen lower by 0.06%. And the markets in the Middle East are closed for the weekend, but regional markets ended the week down as investors had little fresh company earnings and used to relocate their funds or build positions. Dubai's index lost 0.64%, near a 4.5-month low, as the decliners outnumbered gainers to 20-12. In Abu Dhabi, the index also fell 0.62%, dragged down by losses in blue chips. Developer Adler Properties, which is yet to report first quarter results, fell 1.8%. Qatar's index dropped 1.13% to touch a fresh 20-week low as only one share rose, while 16 others declined. In Saudi Arabia, however, the index added 0.42% to end the week at 6,946 points. And it was another record-breaking week on Wall Street, with the technology sector leading the way after a huge day of earnings and data on Thursday. Amazon and Alphabet both beat street expectations, causing Nasdaq futures to surge after hours. The Nasdaq closed at a record high before the earnings were reported, rising 0.39% and at 6,048.94. Well, Jill Malandrino, business correspondent in New York, reports live with more details from the VOA studios. Over to you, Jill.
Hi, good morning. So last night was the busiest of first quarter earnings season, with Nasdaq-listed heavyweights Amazon, Google, Intel, Microsoft, and Starbucks reporting after the close. Amazon had a huge beat on earnings and also beat on revenue. Google, or better known as Alphabet, had a big beat on earnings in the revenue side as well, with the CEO saying that 2017 was off to a good start. Recall, Amazon and Google have been moving the market all year. In fact, most of the technology sector has been super strong, which is why we broke 6,000 this week on the Nasdaq Composite and closed at fresh all-time highs yesterday.
Now, Joe, how focused are the markets on President Trump and his policies, especially as he approaches his 100th day in office?
Well, surprisingly, markets have held steady, even though there has been some flip-flopping on healthcare reform and NAFTA. Typically, one thing that markets do not react well to is uncertainty, yet we have had a massive run in the market since Trump took office, despite a lack of direction and clarity from his administration. Trump reversed his tune on NAFTA, a trade pact which he railed against as a candidate, and as recently as last week, because he declared it harmful to U.S. workers. Now, Trump, Canada's prime minister, Mexico's president, agreed not to terminate NAFTA at this time, with Trump saying it would be a shock to the system, and he wants to see if he can make a fair deal for workers and companies. If that can't be done, then he will reconsider terminating the program. And besides Trump upsetting his base, is it really a bad thing if he relaxes his stance on NAFTA and more complicated policies he may not have understood going into the office? Most of his campaign promises were ill-advised anyway, and why he's coming to more middle ground. Look at NAFTA. About 14 million U.S. jobs depend on trade with Mexico and Canada. Overall trade between the three NAFTA partners, the U.S., Canada, and Mexico, has increased sharply over the pact's history, from roughly $290 billion in 1993 to more than $1.1 trillion in 2016.
Now, even though this week was very busy for earnings, but we're not quite out of the woods yet. Well, is the focus going to shift to energy companies, for instance?
Right, that's right. The focus will start to shift to energy companies. ExxonMobil and Chevron report this morning, and the sector has been under pressure relative to the rest of the market. Since February, the S&P 500 energy sector index declined 5%. It lagged all the other 11 S&P 500 sectors over that period and is the worst performing sector year to date, down about 9.1%. Now, with oil prices below the $50 level and supply at record levels, it seems as though expense reduction is driving the earnings season more than higher oil prices. Now, research firm CFRA, they maintain their underweight recommendation for the energy sector. They believe price volatility is expected to continue, and until there's a defined reduction in global oil inventories, you're going to see that pressure on oil prices. Now, given such a high correlation between energy prices and earnings, they would like to see oil prices to continuously exceed $55 a barrel before CFRA can get more constructive on the energy group.
Well, thanks a lot, Jill, for those updates coming from Wall Street there. Jill Malandrino is a business correspondent at the VOA in New York.